Good morning! Today's show is brought to you by Lamp and Starry Night Van Gogh running shorts, baby! Light taps, let's go! Holy Toledo. You guys asked, the mistress is back, the freaking holy grail of all lamps, here to hold down the fort. What is up, everybody? Welcome to Trey's Trades, where we freaking talk fast and don't skip class, baby. I like to preface by saying that I'm not a financial advisor or expert, so take what I say with a grain of salt. Let's get into the video. So today, my friends, my family, my fellow Gorilla Gang, I want to talk about margin calls, because this is a topic that's been hotly discussed and kind of asked about over the last 24, 48 hours. What is a margin call? When margin call? Can hedges get out of margin calls? Who is margin call? You know, we'll walk you through this entire process and keep it as simple as we possibly can for anybody out there who might be new to, you know, the stock market, to AMC, to the plumbings, the mechanisms, whatever it might be. Well, this is for you, right? So let's just start into the video. Two things you need to understand: account value, which is cash, as well as the difference between that and margin. So account value, what is this? This is your actual settled cash, right? So let's say that you have $100,000 in your broker that you deposited, you starting day one, right? That cash, once it settles, that T2 system, right, is your account value. That's your cash. That's your settled money. It's yours. You can do with it what you want, right? You can decide to, if you're a hedge fund, waste it all on shorting AMC stock, or you can decide to do something else, go long on AMC stock, right? It's your money. That's your cash, right? Margin and leverage is two different things, right? Now, with cash and your normal account value, you know, a cash balance account, it takes time for things to settle, right? You've got that T2 settlement system. So if you're using purely and strictly a cash account, you don't have access to your funds after you press the sell button for possibly a couple days, right? It depends on the broker, but typically you got that T2 system. 2 days for transactions to settle so that you can use that cash again. With margin, what happens is they spot you money until that cash actually settles, right? And you're gonna have a different variety of things. We're gonna primarily focus on leverage because this is where margin calls really come into effect, but you can also have a one-to-one margin account. I mean, if you have $100,000 of cash, they give you $100,000 of buying power, BP. You can think of buying power essentially of how much money you have to play with in the stock market, right? But the cool thing and the important thing with margin is that it accrues interest. So even if you are using a one-to-one margin account, if you're holding a position on margin, it does accrue interest on any given security, right? The interest depends on a couple different things. If you're long on a stock, short on a stock, how hard to borrow the stock is, how risky the stock is, right? There's a lot of different facets that play into this, and it does also depend on your broker. But leverage is where you really get into trouble with margin calls. Now, how does leverage work? Why is this important? So leverage, I'm just going to use a simple example of a 2-to-1 leverage setup. In this instance, a 2-to-1 leverage would mean that you get 2 times the buying power of your actual settled cash account value, right? So in this instance, if you had $100,000 account value settled cash, you would actually get to play with $200,000. Essentially, your broker, whether you're an institution, whether you're a retail investor, they spot you an extra $100,000 and you get $200,000 of buying power. In a 4-to-1, it's the exact same thing, right? If you have $100,000, you actually get to play with $400,000. And the risk goes up and up and up and up and up and up and up. The more you're actually playing with in buying power, the more leverage that you've got, right? Because it takes less of a loss to be able to trigger a margin call, right? Now, we'll get into what triggers margin calls here in a little bit, but this is a really important thing to really understand in any sort of margin situation, leverage situation, which, by the way, if you haven't seen any of my videos, I think there's a lot of heavy leveraging taking place in the stock market. I think banks have given out a lot of loans to a lot of institutions, and I think institutions are playing with money they don't have, to be completely frank, right? We're actually going to give you an example of what a margin call looks like towards the end of this video as well. But that's sort of what you're looking at. And the margin requirement, or you can think of the margin maintenance requirement, right? This is essentially what triggers margin calls. This is the level. And this depends on different brokers, whether it's a prime broker, institutions, or just a regular broker that you've got with Webull, Robinhood, blah, blah, blah. You know the whole spiel, right? This is exactly what determines when the algorithm takes place or your broker takes place, the bank steps in. You don't get control on whether or not you get liquidated, other than if you were to settle the margin requirement, right? Now, I've actually got an example here for you of what this looks like. So a margin maintenance requirement would be right here. So this depends on the broker. You can have sometimes, 15%, 25%, 30, 40. It depends maybe on the risk of your security. Depends on the broker you're going with, right? New York Stock Exchange and FINRA, the regulatory body for the majority of security firms operating in the United States, requires that investors keep at least 25% of the total value of their securities as margin. Some brokerage firms will require more, 30 to 40%. So here's an example, right? If you were to use 30% margin requirement and you had $5,000 on a 2-to-1 leverage, meaning that you get to play with $10,000 off of your original $5,000 of cash. What ends up happening is once you meet that 30% margin requirement, which in this case ends up being just below $7,100, you get what's called a margin call. Someone knocks on your, no, not literally, not literally knocks on your door, but you get a phone call, you get an email, you get a text message, somebody gets a hold of you and says, hey, look, you've got X amount of time. And this time can, greatly differ depending on whether the broker is, how much you're out, right? It could be a couple days, it could be 24 hours, it could be a month. It just depends on the scenario, but you're going to call them. They say, hey, look, you've got a couple different options here. You either have to maintain that margin maintenance requirement. You have to liquidate some securities. You have to add some marginable securities, or we're going to forcibly liquidate you fuck. That's what it comes down to, right? So here's the whole process kind of drawn out for you. So in 4 main steps, you've got a bank or a broker and you've got an investor. This can be an institutional investor or a retail investor, but we're going to talk about the institutions here. Let's say that this investor has $100 million and they're going to be playing on 3-to-1 leverage, right? Meaning that they get to play with $300,000 or $300 million of buying power on their $100 million. What happens in step 1 is this bank/broker, it can be either or, spots them $300 million or $200 million, right? I meant to draw 2 here. $200 million goes out, and now this investor on his original $100 million of cash has $300 million, right? He ends up putting this into the market, right? He can go long on stock, he can go short on stock, he can do whatever he wants to do. He doesn't have to use the actual full amount of buying power with that 3-to-1 leverage that he's got. But let's just say that he does, because we know there's a lot of markets out there. There's a lot of institutions out there who are heavily leveraged in the market. $300 million goes short into the market. He essentially decides to bet against the economy. He decides to bet against the company. And this is where risk really gets astronomical playing with leverage, because you have infinite upside for losses, right? So 3-to-1 leverage, by the way, it does not take much of a loss to really come out the hole and to get a margin call if that sort of situation was to happen, because the majority of what you're playing with for money isn't your money, right? So let's say that somebody buys a stock at $10, right? Or they go short a stock at $10, and all of a sudden it runs up to $12. Well, all of a sudden he's down 20%. This institutional investor is down 20%. So off of $300 million, what would that come out to, right? Let's just think about that. 300 million times 0.2 is $60 million that he's out. But how much of that is his actual own money, right? If you were to take 0.33 times that, 20 million of that's his own money, 40 million of that is the bank/broker, right? That's problematic. That's problematic for this bank or broker. So at some point in time when the losses get big enough, they start having margin calls. They start saying, look, you have to either A, maintain your minimum margin maintenance requirement, or B, liquidate some stock, or C, give us some marginable securities, right? There's a couple different ways that can work out. But to finish off this process, right, in an ideal world when no margin calls happen, eventually they decide to buy back this stock, right? At least the amount in which they ended up putting into the market, $200 to $300 million. Let's just hypothetically throw that number out there, right? They end up buying back that stock, hopefully at a lower price, maybe at a higher price, right? We know what's going to happen here, but you get the whole picture. And then they return that $200 million back to the bank or broker, and their maintenance requirement is good to go. They don't have that buying power actually being utilized in that current moment in time. Well, in a margin call, the situation looks different, right? So you went short on a stock at $10. Not looking at anything in particular, maybe AMC, who knows? But the stock goes up. Let's say it goes from $10 to, I don't know, hypothetically trading at, 55. I don't know what's at right now. It's currently sitting at 53.7. Let's just say hypothetically it goes to $53. Well, look at this. Interesting. So you went short the stock at $10, and now all of a sudden it's trading at $53. So you are down, I don't know, pretty 400%, something astronomical. Well, if you're on a 3-to-1 leverage, guess what? Not only are you out of your money, but you owe your bank/broker a lot of money. Now, you might be thinking to yourself, right? How come they haven't had a margin call yet? And this comes down to a couple of different ways that margin calls can work. You can add cash to your account value to maintain that overall margin requirement. You can liquidate, which I don't think has happened yet. You can have marginable securities put into your account or essentially used as collateral in its place, or you can force liquidation. So I don't think this fourth one has happened yet. I don't think a forced liquidation has happened. I think it's inevitable the way that this has been running. I think what has been happening is 1 and 3. You're playing with some people out there who are working with billions of dollars. Billions of dollars. So anytime, I'd be willing to bet you that there's some big hedge funds and institutions, firms out there who have gotten margin called on AMC who are short on the stock. And you know what they did? Instead of just liquidating and admitting they were wrong, they add cash to their balance, right? They add money to their overall brokerage firm, which maintains that maintenance margin requirement, right? Either that or marginable securities. They add, some sort of security that essentially acts as collateral to that overall account so the bank and broker is happy, saying, hey, look, you want to keep playing the game? You can keep playing dumb games and winning stupid prizes, but, you just got to keep adding that cash. This is, to me, what's been happening lately. Now, I want to show you an example next of what can actually happen here in a margin call. So I've pulled up for you Discovery. Now, this is a stock that actually got, a margin call ensued for a massive, massive sell-off on Discovery stock. It was an astronomical sell-off. $79.59 at its peak, down in about a week to $34.60. That's a 50% loss from $79. That's astronomical. That's more than a 50% loss. And what happened is RK Ghost got margin called on the long side. They got liquidated out of a long position, which ended up making this stock plummet because they had to exit their positions, forcibly exit their positions. They didn't have any control over that. And if this happened on the long side, it can also happen on the short side. The short side meaning a short has to buy back its shares, which forces huge price swings. And that, to me, can very easily happen in AMC stock, right? It can easily happen. So see this exact move for the downside on Discovery, right? That same sort of move can happen for the upside on AMC. If you get a margin call on a short position, it can force an upside move, right? Huge, huge, important piece to talk about here. Hedgies, if they don't have the cash or the securities, essentially collateral, do not control liquidation. They cannot. Money buys you a lot of stuff. Money buys you freedom. I've said that a million times. But if you don't have the money, if you've pissed away all of your capital, all of your account value, all of your cash, and you can't any longer maintain that maintenance margin requirement, right? You have to get liquidated. Your shares are toast. They're cooked. They light you up in flames. So when margin call, this is a very complex question. But this, to me, you're playing with some big boys in the pond, my friends. You're playing with sharks. These guys, these big hedge funds and firms, they've got a lot of capital. They've got a lot of freaking money. So it's when these guys can no longer afford to keep putting money into their broker, their prime broker, to maintain their margin requirement. Once that happens, margin calls ensue because then there's no control. The only control these hedge funds have is if they have more money, right? They can essentially just pay off their margin balance and keep riding the stock, keep taking their L, keep taking their L, keep taking their L. But when they run out of capital, right? When they put themselves so deep in the hole that at some point they decide it doesn't make any more sense to fight the wave here, to fight the current, margin call ensues. That's as simple as it gets. And that's essentially what a margin call is. It's going to happen. It really is. The longer that this continues to run up, they accrue interest, their losses continue to stack, right? And the hard to borrow stock on AMC, the cost to borrow is astronomically high. You throw the cost to borrow on top of the maintenance margin, right? The margin for 2-to-1, 3-to-1, 4-to-1 leverage, they are taking crazy losses. You can't even play leverage on AMC and Webull for good reason. I think it's a fair statement, right? So it costs the little guys nothing. When we say it costs the big boys everything to hold, it's because it does, right? Margin requirements, you accrue interest. You accrue interest big time, right? Hard to borrow stock, you're shorting a stock, it costs interest just to freaking take that security, even if you aren't going to use leverage. Costs them everything to hold. Costs the little guy nothing. And that's what I've got for this video. So blah, blah, blah. I know let's go drop a like, consider subscribe. Whatever you want to do, my friends. Catch you on the next one. Much love, light taps, and peace.